is going to be speaking in a couple of minutes. He and I have been talking a lot about this challenge and issue of how will your kids own their own home. It's an interesting issue that we're facing in today's world, and one that's very dear to many of our hearts. Is how are we going to be able to get our kids into the real estate market, knowing and feeling how difficult it is. We're seeing that it's harder and harder for people in their 20s and 30s to buy that first home in today's climate. And interestingly, this is a chart that I found, and I couldn't believe I found it. It's a really, really interesting chart, and there's actually a lot to unpack here. But this really tells the story of what it's like to be able to buy in, let's say, the Vancouver real estate market. And obviously, Toronto's going to have similar challenges. To a lesser extent, many other urban centers in Canada will have a similar issue. But what the chart is showing is a number of different things. So it is showing the purple line that starts at the highest number there. That is interest rates, and you can see how those have moved around, of course. It also is showing you the average home price, and that is, of course, guess where that one is going, way up, way up. And you're also seeing a vertical line. That vertical line is showing the number of years that it would take for a 25 to 34-year-old to save up the 20% down payment to buy an average home in Canada, or I should say in Vancouver. So it starts off in 1976 that to save up your 20% down with income, the current income at that time anyways, it would take about 6 years to save up the 20% down. And that number goes up and down and all around a little bit, but eventually you can see that really since the 2010s, this number has skyrocketed to over 20 years, and it's been over 20 years for the last 15 years. So it's obviously showing a major issue or challenge here, which is that the income level has not really changed a whole lot. So the typical 25 to 34-year-old earnings is that yellow line that has been really hovering around the bottom of the graph this entire time period, this almost 50 years that's looking at this. And the earnings required to afford a mortgage on an average home, that is that green line. So you can see it's kind of hovering and wavering around, but of course it has slowly increased. And it effectively is showing that people that are younger, especially the 25 to 34-year-olds, it is really, really tough to get into the real estate market. It's taking longer and longer and longer to save up for down payment. And so we need to look at strategies that allow us to be able to figure out how can we get our kids into real estate. And there's a lot of different ways and strategies to do that. So Christian and I have been talking. Christian is actually authoring a book that talks all about this. So who best to get on this than Christian? He'll be talking about a few of the different strategies and the way that he sees, methods and strategies to get your kids into the real estate market. And then what I'll do is, after Christian is gone, I'll go into a little bit more in the specifics of the mortgage itself and the strategies and qualifications and a little bit just to kind of plug in some of those gaps to give you a better idea of, okay, what is feasible? How exactly could you execute on something like that? So, Christian, I'm going to give you the controls so that you can go through your slides and take it away. And maybe before you get started, Christian, maybe just a quick introduction for yourself, what you do, and just give us a little bit of an idea of who you are.
Kyle, I'm assuming you could hear me okay?
Yep.
Perfect. So thanks, Kyle, for having me on again. I was on last year. So for those of you who don't know me, I have a financial practice called Latitude West Financial here in the Lower Mainland of Vancouver. But I work with clients across Canada and also a few in the US. My practice is primarily centered around real estate investors or people with real estate issues or problems. So I'm a real estate financial advisor, more or less. A little bit different than a traditional financial advisor. But a lot of times it's because of what I believe in. I've grown my wealth in real estate. I believe in real estate. And I found that there was a clientele out there that just was having trouble getting help with their real estate issues, whether it be growing their real estate portfolio, whether it be trying to help their kids to get into the real estate, or whether it's them themselves trying to get into their first home. So that's more or less how the practice started. I wrote a book a couple years ago called Break Your Wealth Ceiling. It is available on Amazon. It really talks about why people should be investing more in real estate as opposed to putting the majority of their wealth in, mutual funds in the stock market. So the new book, which will be, unfortunately, it's not out yet. It should be out in Q1 of 2026. We're just actually finalizing the audio. We're finalizing the editing, but it'll be called Priced Out. And it really is talking about solutions. What are some solutions to help the next generation? It's actually specifically written around unaffordable cities, Vancouver, Toronto, cities in the US. We all kind of share this same problem, and that is this unaffordable housing. To be mindful of time, what I want to do is I kind of want to land really, really quickly on some of the solutions, talk about the problems, and then it'll coattail into some of the solutions that Kyle has in terms of mortgages. So let's see if I have control here. Okay, so the idea behind it is understanding the housing problem, how we can help, our children, and this is helping children even if they're under the age of 5, or children whether they're teenagers or children who are in their 20s and 30s. It basically talks about of course, the sooner we get in front of the problem, the better. But if you already have a child who is trying to get into the market, or if you yourself are trying to get into the market and potentially you can get, family help, then this webinar is for you for sure. Okay. So one of the things we want to start with is the barriers to home ownership. So one of the analogies I put in the book is like catching a moving train. And back when my wife and I first bought, or even a generation before that, the train wasn't going that fast. It was, think of a train, think I just got to sprint a little bit and I'll be on the train. I don't really have to break a sweat. Today, imagine that the train is now going, but at a much faster rate. And so that even if you are trying to run and catch it, you're probably not going to catch it. You need an accelerant, you need a bike, you need a car, you need something that is going almost just as fast as the train. So the problem with that is the last generation saying, well, I was able to buy my own home just by doing a little bit of savings. Why can't you? It's the same analogy. The train was going slower a generation ago. It's going too fast now. And this price to income ratio is what I talk about in the book. Like a very, very affordable market is like a household income price to income ratio of 3 to 1. So that's I have $100,000 household income. I'm trying to buy a $300,000 home, which is appropriate, home for me. There's still a couple of places, most of them are in the prairies or in rural areas, where in Canada it is still 3 to 1. So I did the math when my wife and I bought here in the lower mainland of Vancouver 20 years ago. Our price to income was 5 to 1. So we bought a $350,000 3-bedroom townhouse, and the income that we had, my first career was that of a teacher. My wife was a teacher as well. It was 5 to 1. We were able to save up 3 years of hard savings, living off of one income, paying down some debts and student loans, and boom, we had a down payment with 3 hard years. You can't do that today. It's just not going to work. 3 years of hard savings for a couple to get into an entry level, 3-bedroom townhouse. Unfortunately, the math isn't going to work. So the math that I did is today in Vancouver, we are the highest price to income ratio in Canada at 14 to 1. Some neighborhoods even higher. So if you had $100,000 household income, that's a $1.4 million home. And I know right away people are like 1.4. I'm trying to buy a 2.1, or like they're condos at that price level. So automatically in some neighborhoods it's even higher than that. So I want you to imagine that your parents were at a 4 to 1 or a 5 to 1 price to income ratio, and they're telling you to, work hard and try to catch that train. It's 14 to 1 in some areas. Now, the problem is the next generation, and I'm talking about, like my kids. If the trend continues in Vancouver, And if we just keep going at the same pace that we've gone in the last, 10 to 15 years, and if incomes go at the same slower pace, we're looking at as high as 25 to 1. So my numbers land between 20 and 25 to 1 for the next generation. So right away, we have a housing crisis for sure. We've got a housing crisis. And now there seems to be this trend, and the trend is what I'm not liking either. People who have just given up, I've given up. There's no way I could afford because I've been trying for 4 or 5 years to save up and I haven't even put a dent in what I could afford. So they just kind of throw their hands and they give up. That's one message I don't want people to do. There is hope. When the book is ready, read the book. We need some creative strategies, but the old method of saving, why don't I just gut it out, save up 20% of my income, 10% of my income, and then in a couple of years I'll be able to buy a house because that's what my parents did. Those days are gone. The train is moving too quickly. And so what I'm finding is that's how the rules have changed. The numbers have changed. And then I talk about what I like to call the grandparenting gap. And that's where we are now moving further away. We have to move further away from our parents, which means that our own kids won't really know their own grandparents just because of affordability. And so what I'm looking for is win-win solutions. So win-lose solution is why don't I, as a parent, give my child $300,000 as a down payment and take that out of my RSPs or take that out of my wealth? Well, they win, they get a down payment. I lose because now, my savings are cut by a third or cut in half. What I want to do is in the book come up with win-win solutions. So to be mindful of time, I'm going to glance over these really quickly, kind of give you guys a little bit of teaser for when the book comes out. So here are the quick 5 solutions. The first one is called 3 for 30. 3 for 30 is when a parent can help support their child by giving them free housing or inexpensive housing in their home so that they can gut out 3 years of savings where either living rent free or incredibly reduced, where they're saving in the neighborhood of 70% of their income. And if they've got a partner, if they've got a spouse, dual 70% income saving for 3 years. And what you gain is 30 years of equity because we've entered into the housing market very, very quickly within 3 years. So you're actually entering in, like starting from zero down payment. In 3 years, I've suddenly got a down payment. Co-investing is one of my favorite ones. This is where I've got TFSAs, I've got RSPs, I've got money, and it's gaining 6%, 7%, 8%. Now I'm going to take some of that money, let's call it 200,000. I'm going to co-invest with my child's home, but I'm actually going to get my $200,000 back. And I'm also going to get the 8% that I would have gotten in the stock market. Now, I help them get their first home with this 200,000. And when do I get my money back? When they sell and or when they refinance. So they might need to upgrade that condo in 6 or 7 years from now. I get my money back. They get all of the leftover equity and they're already in the housing market. And you have the choice. You might not ask for it back, or you might ask for it back even at a later date and let them keep building the equity. So you don't lose from your retirement. You don't lose from your wealth because you're actually receiving a portion of this thing back. If talk to your accountant about any sort of tax consequence, but remember, all the money that remained with them is capital gains tax free. So all that equity for them is capital gains tax free. Multi-generational living. This is where we get creative. This is where, I can't help my child, but I do have land. I do have a house. I do live on 10,000 square feet, and the zoning laws have changed. So maybe I could put on a laneway. Maybe I can rejig my house, and it doesn't have a 2 bedroom suite down there, but maybe I can rejig it. So, but who's got to pay for it? It's the child that pays for it. Them and their partner, they might not be able to afford a home, but they might be able to finance a build. They might be able to finance the laneway. And now they have an equity portion in the home. So they now have their own space. They're contributing to an increased value of a home. And then on the exit, maybe 5 or 6 years, You could refinance the home so they can get their equity out. Or maybe you're all going to sell the home and they get their portion and you get yours. Maybe you're ready to downsize. But the idea behind it is you're helping them because you actually have a home, you actually have land. And you remember the whole premise is keeping them close. Okay. So early inheritance. This is the one where I find that if you work with a financial advisor and they calculate your wealth and they calculate how much you need for retirement and they calculate every single dollar that you're going to need, and then they then calculate the leftover. Now, let's say the leftover, I'll just throw a number out there, you need $5 million, dollars, okay, by retirement to have the most lavish retirement. But a financial advisor calculates that you're probably going to finish with 10 million, right? Now, you don't have 10 million now, but you do know that there's going to be this leftover. And then that you say, well, where's the leftover going to go to? It says, well, I'm going to give the leftover to the kids. And let's say I've got, 5 kids. So each kid is going to get $1 million. That's the 5 million left over. But maybe they don't need $1 million in their 60s when you pass away in your 80s. What they could use is $100,000 or $200,000 now in present day dollars. And what they're doing is you're giving them an early inheritance, but you're not actually affecting your retirement because the financial advisor has calculated this. So now, would they rather have $1 million in their 60s when they've been renting for 40 years? Or would they rather get into home ownership now in their 20s when a financial advisor has calculated how much you can spare? So that's what an early inheritance looks like. So the last one, and this is the one I'm going to land on a little bit longer, and then I'm going to coattail into Kyle, and this is reverse mortgage. This is kind of like the last stop. This is where a line of credit, maybe you can't afford the line of credit, or maybe you can't afford to service the line of credit. Maybe you don't have the 200 grand in extra in RSPs. Maybe you don't have a house that can create the generational living, or create, the opportunity for the 3 for 30. So here I'm going to take an example out of my book. The reverse mortgage. So the parents have got a home. Maybe it's fully paid off, lots of equity in the home, but they don't have any cash to give the child, and maybe the line of credit isn't appropriate to pull it out. Or even if they did pull out the line of credit, there's no way to service it. They don't have the cash, and the child doesn't have the cash. So the problem is, you got equity in the home. Child has a need for a down payment. Parents have only got the equity and they have no way else to help. Maybe they're already actually in retirement. So let's imagine that using the reverse mortgage, $200,000 could be freed up. Okay. Now with the reverse mortgage, you don't have to pay any payments because there's an interest rate that's charged against you, and it just stays inside the reverse mortgage. And what ends up happening is that the equity in the home is actually going downward. Okay. Kyle will talk about this more, but that equity, sort of the reverse mortgage, it needs to be paid back either when the home is sold, or when they move, or when they pass away. So, and then there's a qualifying as well. But let's just use my example. A $1.6 million home is what we've got. Okay. But this $1.6 million home, it's not being sold, but there's no mortgage against it. But right now, a 200,000 can be borrowed against it. Now, what's going to happen is over time that the home will keep growing, but now the child also was able to get into a home with that 200,000 because of course you're allowed to gift it. So I've done the math, and I used a 6 point, I believe, 7% interest rate on the reverse mortgage. So it's not cheap, right? Line of credit, maybe you can get prime, right? Or prime minus something. But a reverse mortgage, the interest rate. So let's be transparent. The interest rate is higher. But an expensive market like Vancouver, I want you to remember how fast and the growth is of the home that you just helped your child get into. So the $200,000 is going to get us a $1 million home. So imagine that your son and his spouse, they qualify for an $800,000 mortgage. They just don't have a down payment. Okay, you give them the down payment of the 200,000. Now, the $1 million home is going to grow in the hands of the child. Now, the equity in your home is going to grow. You're just going to reduce the amount of value because of it. So here's where the numbers land, and I'm going to go 20 years later. 20 years later, the $1.6 million home is going to grow to 6.2 million if we stay at the current rate of Vancouver. But that $200,000 reverse mortgage has now turned into $800,000 of depleted equity from the home. That still leaves $5.4 million of equity inside the home. Yeah, but I could have had another 800,000, but the child, the adult child, now has a $3.7 million home because his $1 million home has turned into $3.7 million 20 years later. Now, right, that's 3.7 million of equity. The home itself is worth 3.87 million, but he still has a little bit of mortgage on it. So the beautiful thing is Kyle, myself, we could run these calculations. We could figure out whether it makes sense. We're not telling people to do a reverse mortgage. We're saying it is an option. It's a great option for someone who has equity in their home and they're not planning on selling it anytime soon. Somebody who wants to help a child to get into an expensive, Vancouver housing market, and they somehow don't have the ability to service a monthly fee, like a line of credit or something of that sort. And so right away, this is such a wonderful option for people who want to help that next generation. Now, one of the reasons why I only use 200,000 is because maybe you have multiple children and you want to equalize it. You also want to do some will planning to make sure if one child gets, this amount of a mortgage and another child didn't, a good will can be settled to make sure that everyone gets their equal share as well. And so just as a kind of like a 360-degree view, that is the reverse mortgage solution. I know that reverse mortgage kind of got a bad name a while ago. There was kind of like a bit of a slick salesman style of placing them with some of the ads on TV and things like that. But I think you can't kind of use one paintbrush to paint the entire solution. I personally know clients who have got into housing right now because their parents did take a reverse mortgage, paid out some student loan debts for their child and helped them to get in. And of course, the equity that they've built now has completely been worth it. And they knew that they were going to help their child out anyway. They knew they were going to inherit this home, but they were still living in the home. So really quickly, that's kind of an overview of the math. But let's talk about some considerations over here. So first, the advantages. Child gets in early. They start building their wealth, their equity, capital gains tax free. Remember, if they inherit the equity in your home or your RSPs or TFSA, there is taxation. There's no taxation to spouse, but there is taxation to child. Now we're able to get them this equity actually tax free, and the growth is also tax free. The parents still live in their home. They didn't have to utilize anything. They didn't have to pull anything out. There's no line of credit to service. Okay. The other thing that it also does is it keeps them close, right? It keeps them in the neighborhood. It keeps, that generational community that I'm talking about. So some considerations over here. You got to be comfortable with the loan compounding against you. Yes, it comes at a little bit of a higher ticket price, but at the same time over here, we could do the math to see if the cost benefit outweighs it. In this particular case, it absolutely does. Understanding that there could be, estate planning issues, because if there's multiple children or grandchildren or something of that sort, so you want to work with a good advisor who understands the value of this, as well as understand some guardrails to make sure that that everything is very transparent for everyone in the family. So one of the things that I want to talk about is a tool that we have at Latitude West, and we offer this tool for free to free to potential clients and also clients, and it's a way of us analyzing. I've just talked about 5 solutions. Which is the best solution? Is it the early inheritance or is it the reverse mortgage? Is it the co-investing? So we actually created a tool which actually helps to narrow down which is, the best 1 or 2 solutions for you. So at the end, I'm going to kind of show you a way to reach out to my team to get the tool. If you're listening to this and you're saying, yeah, I'd like to try to figure out a couple of those options will probably fit my scenario. I could talk to my parents about it, or I could talk to my, adult kids about it, but it would be good to figure out which is the best one. So the tool for us helps us to come up with a numeric solution. Which, in this example over here, is it better to do the reverse mortgage or the early inheritance? This one brings it down to a number. It's the difference of retaining 1.1 million versus 1.5 million. And then we could kind of help to guide you to say, for your specific scenario, this is the better option. So some next steps over here is number one, if anything that I've said resonates with you, then start a family conversation. Unfortunately, all of my solutions do involve someone else. It does involve the parent or someone willing to co-invest or someone willing to, let you live kind of, rent reduce. So really talk to them. That's the first step. Engage with your financial advisor or your accountant or your team to say, does this work? Does it make sense? Because they might have to take some money out of their wealth. So you want to make sure the advisor and everyone understands what it is you're doing. If you don't have an advisor, you don't have an advisor who understands this, of course, you can absolutely reach out to us. All of our first meetings are completely complimentary. We're happy to point you in the right direction or show you more how we can help. And then what you want to do is you want to, set out like a plan, like you want to customize a strategy. Maybe it'll take you 3 years, maybe it takes you 3 months, who knows? I know that I've had clients where they were planning to buy a home in 5 years. They were diligently saving. We worked together and they ended up buying a home in 5 months. When we started incorporating their strategies, because they never really thought about tapping into equity of a parent, or they didn't think about a co-investment option with a grandparent. So what I want to do before I pass this over to Kyle is kind of give you guys this opportunity to connect. Number one, one thing that you could do is you could scan the QR code and just sort of said, hey, I'd love to kind of get access to this free tool. What it looks like is it's a request. You would just put in the comments that, please send me this tool. The tool is in the form of, it's kind of like a survey question. It gives you a series of questions, and then we send you the report based off of those questions because it helps us to narrow down which is probably your best option. And of course, if you want to set up a complimentary time to talk, tell me a little bit about your scenario a little bit closer. My assistant Melissa is happy to receive that and then book us a time. You could also scan the QR code and just say, hey, I want to set up a time. And then we always say, follow us on Facebook and Instagram. That's an easy way to kind of keep in touch. It's an easy way for us to say when the book's about to be released. Sometimes we do videos to kind of show people how to figure this stuff out on their own. And then all of those are released through our social media. But Kyle, I hope I was meaningful with time. I think I was trying to be done by 7:30. I'm going to flip it back to you, Kyle, and then at the end, if there's Q&A, we both can kind of answer questions.
Yeah, awesome. Thanks, Christian. There's a lot of things to consider here, and I know we kind of ended on the reverse mortgage option, but there's a lot of different ways to fund these different solutions. So whether you're looking at co-investing or helping the kids out or gifting or whatnot, there's a lot of different financing solutions to that. So I just want to run down and give people an idea of the different ways that you can do this, and then touch on a couple of the details. So the first thing is you could just buy a rental property and co-invest with the kids. And maybe what I've had some clients do is actually buy a rental property today that will eventually be their kids' home in the future. So that could be a really good solution. I think that's something that we're seeing a lot more of is them trying to get into a position where you can say, okay, if I buy a rental property today and I fast forward, 5 years when the kid is 21 or finish, university or whatever, then I'll buy a rental now. It'll generate some income, and then I can eventually have my child move into the property, and you can transfer the title to them. In some cases, depending on the situation, you may even buy a rental today, and you both go on the title together, and that means that the title transfer can be a lot easier. So especially in provinces like British Columbia, where there is property transfer tax, we'll be mindful of transferring the title and what implications there may be, and that is a longer conversation, by the way, because there's all of these nuances with first-time homebuyer benefits of not paying transfer tax. If they're on the title of a rental property, then you still have to pay the property transfer tax initially, but it could save transferring the property to them later and perhaps triggering taxes. But if that's their first home, then they might not. So there's all those little nuances there. One thing that is also very common It's just buying what's called a second home. So a second home means that you're buying a property either for personal use or for immediate family to use. And so you can actually buy a second home with as little as 5% down. And this is a very common misconception. People assume that 5% down payment is only an option when you're buying your own first home. It is not a first-time home buyer benefit or privilege. It's actually a benefit or privilege that you can use if you're buying either your own primary residence or a second home that your kids could use. So this is an option where if you wanted to control the title, or maybe the kids can't quite qualify on their own, then you could buy something with them and co-own the property together. And from the perspective of the parent, it's a second home effectively with the kids qualifying. So the kids could be on the title or not on the title in that case. And you can put less than 20% down if you do it this way. Now, it's important to note that if you're qualifying for second home, which is personal use, then the lenders are not using any rental income to qualify for the property. We also talked a little bit about early inheritance or gifts. Here's a really interesting stat. The average gift to a child to help them buy their first home in Canada, I'd actually like to see, I'm going to ask the group here, put in the chat what you think the average gift in Canada is. So first-time buyers, and don't Google it, don't cheat. What do you guys think the average gift to a child for their first-time purchase is? Just put it in the chat. 50, 45 grand, the 5% down, 50 grand, 200 grand, 100 grand. Okay, so the number for Canada is $115,000. So that's the average gift that a child receives to purchase their first home. That number seemed high to me. That being said, when I'm looking at gifts, I see a lot of gifts that are very, very large. In fact, sometimes we see $1 million gifts, et cetera. And I think that obviously throws the average out a little bit because a lot of parents are helping out with $50,000 or $100,000 in many cases. But the average in Canada is $115,000. Any guesses on what the amount is for British Columbia? I don't see any chat. And says, here we go. Boom. Okay. 150, 250, 300, 250. Okay. So you guys are catching on. You're like, okay, this needs to be a higher amount. The average is 250 for British Columbia. It's literally double. I think there's another stat that said a slightly different number than 230. I think I may have said 240 or something like that. So it is a lot. It was surprising to me to see the average gift for first-time buyers who received a gift from parents, to see that the number was $230,000. But I think the reality is, it's just so hard for people to buy their first home. So to give you some perspective here, the issue is that in order to qualify for a mortgage, typically you take your income and multiply it by about 5, and that's about the high end of the range. Sometimes it's a little bit lower than that, but in general, you take your income, multiply it by 5, and that's about the maximum loan amount that you can qualify for. Now, the problem is, Christian was mentioning earlier, well, back, a number of years ago, that was the home price. 5 times your income was actually the home price. In today's market now, the average income might be $100,000 for a typical Vancouverite, but the average home price is $1.4 million. It's 14 times. So there's a major discrepancy here between the average income and the average home price in areas like Vancouver. So the problem is, okay, how do you get to qualify? When you put less than 20% down, so you're saving up your down payment yourself, you're in a really tough spot where the qualifications are tighter. You're getting your mortgage insured, and the lenders always use the lower of the common denominator of the insurer rules and the bank's rules. So if you can put 20% down, you at least get to eliminate the insurer rules, and the borrowing power for a bank is a little bit higher. They allow a slightly higher percentage of the overall income to be used towards the debt. And also, the individual is borrowing less money because they're putting 20% down. So, looking at $1 million home, for instance, the borrowers would need about a $200,000 income in order to qualify for that at minimum. It's probably a little bit more than that, probably like 225. However, if they put 20% down and now they only need an $800,000 mortgage, they could probably get away with only about $160,000 income to do that. possibly even a little bit less in some cases if the lender is extending the debt servicing a fair bit. So a refinance to produce a gift or an early inheritance is something that that is coming up quite a bit. You still, if you're doing that as the parent to gift or give your kids some money, you're still qualifying when you're doing a refinance based on your income, which is something that's relevant and important here. And then by providing your kids some money, it's just a little bit easier for them to be able to qualify for their own mortgage. So that's another option when you're looking at like what are the financial abilities or restrictions here. And then the last one is the reverse mortgage, which Christian touched on a bit. And that is another way of being able to use for early inheritance by producing a gift. The biggest key here is the reverse mortgage means you don't have to make a payment. So it's a payment optional mortgage. You can still actually choose to make payments, but you don't have to make a payment. Another option you can do with the reverse mortgage too is you can actually buy an investment property. So you can see that we have an option here for a rental purchase. You could actually get a reverse mortgage on your home, use that cash to buy a rental property that eventually the kids may buy from you in the future. So even if you have kids that aren't of age where they're ready to buy yet, but you just want to put your stake in the ground and say, okay, I want to get something so that when they are old enough, we've got something that they'll be able to move into. But you're worried about being able to afford the payments and worried about that debt. A reverse mortgage could be a solution where you don't have to make a payment, and there's a ton of things that you can do from a tax perspective because interest is still accruing. You get to write off the interest on the original principal balance, and there's all these other little benefits. I won't go super deep into that because we actually did a presentation on reverse mortgages last month, and so you can learn a little bit more about that. So I'll just quickly touch on a couple of the key things just related to reverse mortgages, just because we always get a lot of questions about them. But it's a loan that's secured against the value of your home. You'd have to be 55 years or better, and you can get a loan of up to 55% of the value of the home. Generally, the older that you are, the more money that they're willing to give to you. And anytime you take money out of a reverse mortgage, it's tax-free. So there's no government pension impact or anything like that, and you don't have to make a payment. You maintain control of your home. You never owe more than the value. Is that to qualify for it, it's based on the equity. There is no, or at least there's a very, very minimal income requirement. You just have to show that you have enough income to be able to pay the property taxes and other minor living expenses. And so we do find that people are often using these in order to stay in their home or to produce additional cash flow, but also providing an alternative method of qualifying for a mortgage where income is not a factor. So I've had some clients that want to help out kids or even just want to work on their own situations. Sometimes an alternative lender is the only option that we could assess other than a reverse mortgage. And in that case, if you're going to be paying a higher rate and fees to go to a B lender, then sometimes a reverse mortgage can be more attractive in that case. So what we've seen is sometimes people are using it to invest in real estate, buying the property. There's no payment on the reverse mortgage, but then they're getting cash flow. So this is going to be a strategy if you wanted to buy a property now that the kids aren't ready to move into. This could be an option. You could actually technically do this to buy a property the kids are ready to move into it, but then you wouldn't have income coming into you to offset any, to basically produce an income for you. But also, if it's not an investment from your perspective, then you can't write off the interest. And the early inheritance one is the more commonly seen one, just because it's so difficult to qualify for. And you're basically just changing the age. So as Christian mentioned, it doesn't make a lot of sense for people in their 80s to eventually pass the family home and the equity in that family home to people that are in their 60s who may not need that $1 million now, but they could have used $100,000 or $200,000 when they were in their 20s or 30s. So just getting them a head start. And yes, as Christian mentioned, the reverse mortgage over time, that is compounding on itself. And so the amount that you owe will compound upwards. Now, interestingly, we've done this graph and looked at it based on the interest rates and based on the loan amount that you get. In Christian's example, the net equity in the parent's home actually still increased over that 20-year period. And that's because the appreciation rate on the total asset value versus the appreciation or interest rate on the mortgage amount is relevant. If you borrowed a large amount of money on the property on a reverse mortgage, then that's something where you might find that the equity will slowly erode in the home. But if you're borrowing an insignificant amount of the value of the property, depending on the appreciation rate over time, and you may find that actually your home value and your home equity, net equity, is still actually increasing because the value of the home is appreciating faster than the mortgage is increasing. So just something to think about. And there's lots of charts and graphs and things like that that we can produce if you wanted to do that. And then last but not least, I mentioned before that it's an alternative to equity lending. So I think there's a lot of things to consider when you're looking at, how to help your kids get into real estate. We've talked a lot about just the 5 different solutions that Christian laid out. We talked about a few of the different ways and paths where you can, how you qualify for a mortgage, if you could buy a rental property now that they could move into or buy later, buying a second home or qualifying with them to buy something, refinancing to give them money in one way, shape, or form, qualifying for a standard mortgage, or if the payments are an issue or qualifications are an issue, then a reverse mortgage potentially. And then the other things that I wanted to kind of highlight before we open it up for Q&A is there's a lot of considerations on the estate planning. Estate planning goes very in depth. We actually had at our events that we hosted about 3 weeks ago, 2 or 3 weeks ago, we had some lawyers actually go into estate planning, and I learned a lot at the event. There's a ton of stuff to consider. All of these different types of wills that you can set up and whatnot. But Christian is right. If you're giving one child some money, you have to make sure that you ensure that you figure out, okay, well, I need to make sure the other kids are covered off, and there's lots of ways of doing that. One other consideration too that I've seen is sometimes, and I know that a lot of people don't even want to bring this up, but it's a fact. Let's say that your son is getting married and buying a new place with his new girlfriend or daughter, or not daughter, girlfriend or new wife. Sometimes there's a concern that what happens if I give them money and then they split up later? What happens to my money? And there's also a lot of different routes and options where you can get a legal agreement that ensures that that money comes back to the parents, back to you guys, if they were to split and something was to happen. So you can talk to lawyers about that. There's lots of different methods to handle that part. Property transfer tax, you do have to have some planning on property transfer tax. There's some pros and cons. There's some benefits that first-time homebuyers get, but only if they meet certain criteria. So it's really important that whatever plan you come up with the kids is considering property transfer tax. And then I know Christian touched on this, but it's a important point and not something that us finance guys always necessarily put down on the piece of papers and the plans, but it is keeping the family unit closer. I'm noticing a lot of people that are my age are starting to move to Vancouver Island because they're saying, I just can't afford to live here. I can retain my income because I'm in nursing or I'm a teacher or whatever. I can make the same amount. But by moving to the island, I can actually afford a home. And now they're starting to have kids, and the parents are still living in Vancouver, and now the grandkids are growing up and not having that same relationship with their grandparents. Sometimes then the grandparents have to say, well, are we ready to move over to Vancouver Island or not? And things get tricky. So sometimes this is just a way of keeping the family unit much closer, and sometimes even have a few clients who literally bought the home right next door. Now, I don't know if I would want to live right next to my in-laws. I love them, but I'm not sure if I want to live one house down from my in-laws. But those are different strategies we're seeing. Sometimes people are literally buying even side-by-side duplexes. One family lives in one family lives in the other, and lots of different solutions for that. So lots of things to think about. I think there are some questions in the Q&A, so I'm just going to pop that up here.
Kyle, as you're prepping your first question, I'll give your voice a second to rest. But I wanted to mention one thing that, full disclosure, something I'm doing. I've got 3 daughters. One is 20, one is 17, and one is 15. The one who's 20, we're already looking because the condo market is low. Like, how many times, Kyle, have you said in the last 10 years, oh, the condo market is like really, really low. It's a great time to buy. It's so rare, and that window doesn't happen often. So I know what we're trying to do is to take a look at a 2-bedroom condo in our neighborhood, North Vancouver, and we know that she's not going to move into it like tomorrow. It'll be years before she actually needs to move into it, but I'd rather catch it while it's low. I'd rather invest in it. Is it going to cash flow? And the quick answer is no, not off 20% down payment. But would I rather buy it when it's low? Or am I going to give this money later anyway, potentially when it's high, or in 6 years from now, or in 7 years from now? I'd rather get something where I could rent it out, or I could put it under her name and she could move into it as well. And those options are available to us. So that's one thing I'm doing. The other thing is for those of you who got kids in college, if they're out in Calgary, if they're at UVic, if they're, somewhere, and you've got some reverse mortgage room or some cash, I want you to just think of, okay, they're going to be there for at least 4 years. Imagine, and this is what I'm planning on doing with wherever my daughter decides to go, daughter number two, you know, exactly what you said, Kyle. You can get a second home, or you can get a home under their name and co-invest with them. But now it actually is their primary residence because for those 4 years, they will be living in it. And during that time, like I'll use the UVic example, a 4 or 5 bedroom house. What do these guys do after first year? They're all kicked out of the residency. They all have to rent together. Now imagine them and their buddies are now renting a house, but your daughter is actually the one who's on title owning it. Capital gains tax free. She had to rent somewhere. Her buddies all have to rent somewhere. Well, what is the value of that house going to be in 5 or 6 years from now? Let's say it's not an appropriate time to sell it. Well, now you still got the student rental so you'll have all of these different options. But what I'm thinking is if I have my daughter getting 4 or 5 years of equity, she ends up graduating, maybe it's built up enough equity, capital gains tax free, that we can now sell it and she could take that equity and now bring it to her first home. But I gained 4 or 5 years of capital gains tax free. I gained an entry into a low market, and I had 4 other people paying down the mortgage. So it's another one to think about. All right,
Yeah,
Kyle, if you've got some Q&A,
good.
back to you.
We actually brought up something else that kind of jogged my thoughts here, which is there's two things I wanted to kind of highlight. One is in some of these strategies, you may be shifting money that you have. Let's say you have some money in investments, in non-registered investments, earning a rate of return for you. You could be potentially, if it makes sense, it may make sense to actually shift that money that you're paying taxes on the gains, and then instead gifting it to the kids who then are earning equity in their home, and that's tax free because there's no capital gains on their residence. And so sometimes it's a matter of like, okay, now there's two large assets in the family that are appreciating with no capital gains, as opposed to you having your home, which is appreciating with no capital gains, but then you have other assets appreciating with capital gains. So I think the capital gains thought is important. And then as you were mentioning your game plan with one of your daughters of buying a condo close by, and yes, it wouldn't cash flow. One of the things I've noticed, the same thing with 20% down, most condos don't cash flow. I start to look at, okay, what's the expected return on investment by buying that condo? Right now, 20% down, most condos will be negative cash flow by about 2 to 4%. So your investment of, let's say, if you invest your 20% down of 100 grand and buy a condo, you might actually be negative 2 or 4 grand a year. So negative 2 or 4% cash flow on that property. So you're having a negative return from cash flow, but the tenant is paying down your mortgage for you. And right now, that's about a 6 to 7.5% return from the tenant paying down the mortgage for you on the return. So they're going to pay down maybe 6 or 7 grand of the mortgage balance down for you. The other factor is if you do assume that appreciation will occur, and frankly, who knows, especially in the condo market, we don't really know exactly what's going short term. Some people think that it's depressed right now and it may start to go up. But I think in general, I'm telling people that a safe amount of time is maybe 2 or 3 years before it really starts to have a ramp up period, because the cycle for condos can be quite long. But if you're looking at it from a long-term perspective, like a 10-year period, it's reasonable to assume at least a 3% annual appreciation. And so assuming that, if you put 20% down payment, your return on investment is 15% from the appreciation. So if you add them all up, 15% return on investment from appreciation, let's call it 6 even on the mortgage pay down, so you're 21%, and then negative cash flow of, let's say, negative 4% or something like that. You're still at high teens for the overall return on investment, which isn't bad. And you're buying a property that may be suitable for one of your kids to move into and whatnot. So yeah, some things to think about. Why don't I go into the questions? We have some good questions here. One One of the options or questions here is if in co-investing with kids, would you put both parents and kids on title? What are the tax implications of this? So there's a couple of things to unpack here. First off, let's talk about the tax implications. So if co-investing with the kids and you're all going on title, then each of you on your individual tax returns will be claiming an income representative of your percentage ownership. So if each of the parents are 25% owners and then the kid is 50% owner, then you're going to be claiming that net income on the tax returns to match that. If you're co-investing, meaning that you're buying a rental property together. Generally speaking, with the interest write-offs as well as all of the other tax deductible items, usually a rental property isn't positive on the tax returns for some time. It takes on average, I'd say at least 5 years, but usually it's more like 10 years because the first 10 years of the amortization on the mortgage, a lot of the payments are interest, which you get to write off. But eventually there's more of that payment as principal and less as interest. And so eventually that may shift. And also, there's inflationary pressures on rents long-term. There's another consideration here too, though. If you buy a property, this comes up a lot, especially if you want to buy a property for the kids to live in. So now it's their residence. If you ever want to get your own financing in the future, that may be much more difficult because what will end up happening is on your own application, they're going to say, okay, you've got your own mortgage here and you've got your income. That's good. You also have this other mortgage over here. It's, oh, that's my daughter's and she totally pays for it. The bank's going to say, that's awesome, but she's not on this application. And for us, if your daughter doesn't make the payment, you have to make the full payment. And so they will service the entire payment of that mortgage that you have for the kids. And so if it's not a rental property where there's at least some income coming in to offset the expenses, if you buy qualify for your kids' home and buy it with them, now you have to, you're guaranteeing that entire debt and that entire payment, and it can make it a lot more difficult for you to be able to qualify for anything in the future. So something to keep in mind. Anything else you want to add to that, Christian?
Yeah, I was going to clarify because I know a lot of our clients with the strategies that we use is we sometimes put parents down as a 1% owner.
Yep.
And because what we're doing, exactly that. We do need to be on title in order to qualify. But at the same time, since we're not living in there, we are subject to a capital gains taxation on the gain of this home when it appreciates in 10 years when it gets sold. But if we want to be untitled, but we want to be as minimal as possible, one child fee is maximum as possible. So the one I just wanted to kind of throw that out because you use the 25%. Work with a financial advisor to figure out which one it makes the most sense. The other thing I just kind of wanted to add is this, and this is exactly what I've done. If you don't need the capacity, the mortgage capacity. So if you go to Kyle and say, Kyle, what will I qualify for right now if I help my daughter? And then all of a sudden it's 500,000. Then of course there's that layered question. Are you going to need this 500,000 yourself? Are you planning on upgrading your home? Are you planning? Because what we're doing is we're using some of your mortgage qualification capacity. So that's an important conversation. But the quick answer is if you're not, don't let it just sit there. Use it on a capital gains tax-free, for your child. Get that momentum moving. And I know what I did with my house because I'm in the transition right now of upgrading my home because I actually have in-law moving in with me, and nothing wrong with that. Don't knock it till you tried it. Well, that's what I keep telling myself anyway. But I wanted to save some capacity. So the house we could have qualified for because we got two equities from two homes is here. We brought the number down here. So we actually purposely are transitioning to a much smaller house than we could have afforded, but one that fits our needs because I wanted to save the capacity for the children. Because I knew my 20-year-old is never going to qualify for anything. And that's what I mean. You want to work with a financial advisor and a financial team that can look at your long-term vision and your goals to kind of say, oh, Kyle, we're actually upgrading our home. Okay, let's get into a deeper conversation. What about the kids? Oh, they're only 20 years old right now. They could figure out later, well, wait a minute. What if we, leave some capacity? What if there's an ability to co-invest now? Because you can't reverse that later. Right? Once the big house has been bought. So that's one thing. I absolutely think that people should be co-investing with their kids because you got to remember, it's co-investing. You're still getting money, you're still getting equity. Now you could choose to leave that money with them, or you could choose to find a way to get it back by them, re-amortizing the mortgage and you getting your equity out.
Yep. Awesome. One of the things put in the Q&A was 500,000. So I'm pretty sure that was the guess, or one of the guesses for the average gift. And then there was one other anonymous person who mentioned that their parent gifted them $800,000 in 2012. So it's some proof in the pudding that people do receive large gifts. Edward is asking, what is the common rate for a reverse mortgage? What is the benefit of using a reverse mortgage versus a home equity loan? So a common rate is around the 6.69% range that Christian was mentioning. Right now, as of today, pricing is about 6.49%. So it's really close to that, and they hover around and move around a little bit. They don't move a lot. They don't move as much as the market does, because the reverse mortgage is a much longer term type of product. But in general, yes, you'd be using something usually in the sixes or maybe in the sevens if interest rates have gone up. The primary benefit is mostly that there's just no payments necessary, and that means that it can be a better solution for people that can't qualify for a mortgage or do not want to have a payment associated with it. So if you can afford it, it's often better to find a way of getting a line of credit, gifting your kids the money, and less interest will accrue on that debt. Because if you can borrow it at a line of credit at prime, or prime plus a half is kind of the standard rate with many lenders, you're borrowing that money at 4.5% to 5% interest, which is much cheaper than the reverse mortgage. The key is, can you afford the payments? If you're gifting your kids $200,000, then that payment for a mortgage term or interest only would be between $800 to $1,000 a month. So you just have to make sure that you're okay with being able to afford those payments, whereas a reverse mortgage would have no payments. And so, there's some things that you can get tricky with as far as that is concerned. And again, we did a full segment on that last month, and so it is on YouTube if you wanted to watch that, Edward. But yeah, it's a unique tool, and it doesn't work for everybody. It only works in the scenarios where it's a really really good way of reducing the overall cash requirements. And then one other thing that a reverse mortgage can do is you can even have it so that it pays you a monthly amount. So you can set it up so you say, okay, I'm going to gift my kids some money, and also I kind of need a little bit of extra money to live off of, because all my investments are in my home and I'm running out of cash to use to live off of. You can even set it up so that you could receive $1,000 a month or $2,000 a month or whatever to live off of too. So again, not great to use your home like an ATM machine, but it is possible, and that's the major differences with the product. Awesome. Any other questions? We've answered all the questions in the Q&A. I don't see anything else in the chat. Christian, you've put in your email, which is great. Well, actually, Melissa's email. So if anybody wants to connect with Christian, please reach out. And either of us are happy to answer any other questions that you guys may have. We appreciate you guys coming out and attending this. Appreciate you thinking of your kids. That's awesome. Or if your kids attending this, then go tell your parents all about this. Send them the YouTube video when it's up in the next day or so. Connect them with myself or Christian, and we'd love to help and see if we can help you get into the housing market. There is one question that just popped in from Francie. What is the maximum age qualified for a reverse mortgage? So there actually is no maximum age, believe it or not. They're actually more likely to give you more money at older ages, just because, I hate to be morbid, but life expectancy is shorter at higher ages. So there's less time for the mortgage to increase and be less likely for you to owe more money on the mortgage than the home is worth in the future. So there is no cap or anything like that on the age. I think the highest that I've done was an 82 or 84-year-old, I think. But I think others have done once for people that are older than that. Awesome. All right, guys, we'll wrap up. Thanks so much. Thanks for attending, and look forward to seeing you guys all in the next one.
Thanks so much, Kyle.
Yeah, thanks a lot. Thanks, Christian.